right, friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast. My name is Jerry Robinson, as you just heard, your host, your guide, leading you through the maze of the financial world. What a wild couple of weeks we've had in the financial markets. We have a lot to talk about today. Today's episode number 463. We've entitled today's episode Top 3 AI ETFs. Artificial intelligence has really become the rage as of late, and many people are looking to invest in artificial intelligence as we look forward to the future, and it's understandable. I mean, there's a lot going on here, and there's a lot of promise, a lot of hope, but what's the best way to get access to this market? What's the best way to invest in the space? Well, to each his own, but today we're going to share 3 ETFs that we think are very well positioned to benefit from the rise of AI. And I think AI has a very long runway, so we're very bullish on the space, and we'll talk a bit more about that on today's show. But we're going to begin with a brief overview of what's been happening in the stock market, the S&P, the Dow, of course, recently crossing above 40,000 for the first time, the NASDAQ above 17,000 for the first time. We've seen Nvidia earnings that came in, blowout earnings. We also see bonds are wildly oversold. We'll talk about that a little bit. Plus, silver recently burst out above $30. Gold at or near record highs. And so we'll talk about that. Plus, we've had a little bit on the crypto space, a little bit to update you as well on. We had the passage of the FIT 21 bill through Congress. We'll talk a little bit about what that means. And the SEC buckling on Ethereum and approving a rule change that would allow ETFs in that space. So spot Ethereum ETFs probably coming in July or August. So we'll talk about all of those things, plus those 3 AI ETFs in segment 2. So with all that said, let's dive right into today's very special episode. All right, so let's begin with a quick update of the overall financial markets. Here in the United States, the most important index for most investors is the S&P 500. And right now, the S&P is holding well above that 5,000 psychological support. And we're trading just around, just below 5,300 as of this recording. But we've been above 5,300 now for the first time in history. And the markets just continue to show strength. When we look at the market breadth, we see that we're still in bullish territory. We've backed off of some of those highs in market breadth in terms of how many stocks in the S&P are trading above their 200-day moving average. That's a really important number we look for. Right now, that number is about 68%. Anytime it gets above 80% or so, then you start to get a little bit overheated. We even consider taking some profits at that point. But right now, we're still in that bullish space on the S&P 500. So all things being equal, the market is looking pretty darn good right here. Also, when we take a look at one of our favorite markets, the NASDAQ, we can see that the NASDAQ Composite Index cracked above 17,000 for the first time. That came after the Dow Jones hit 40,000, crossed above that level for the first time in history. So we've certainly seen some really big market moves over the last couple of years. And it's not just stocks, that are doing well. We'll talk about Nvidia here in a minute because we're going to get into those 3 AI ETFs and what better AI or what better way to introduce the concept of AI than talk about Nvidia and their latest earnings report. But when we look at the broader markets, we also look at things like, gold and silver. And gold and silver have also really been doing well, as many of you know. Gold, for example, reaching a new high, despite the fact that the U.S. dollar has, been stronger than perhaps many people thought it might be at this stage, considering that We do have the expectation of rate cuts this year. When are those going to come? That's a big debate. Some saying that it's going to come in September. Some say we're not going to get any rate cuts at all. But, quite frankly, I'm pretty bullish on not just gold and silver, but also on the stock market, because we have the expectation of those rate cuts, and rates are currently above 5% at the federal funds rate level. And so typically when you're in that kind of situation, you're going to have the Fed slowly easing those rates, and that's going to provide a tailwind for assets. It's going to provide a tailwind for a further rise in U.S. stocks. It's also going to set up a further rise in things like gold and silver and commodities. Even though we've had a pretty good run in commodities, in some select commodities, overall, the major commodity indices are really trading at interesting lows when you look at various ratios, especially compared to, say, like the S&P 500. And as the rate cuts commence, whether they begin in September, whether they begin in August or whatever, when they finally come, that is going to cause the U.S. dollar to go down correspondingly. And therefore, you're going to have an upward catalyst there for commodity prices to go even higher. So think in terms of the U.S. dollar as kind of a seesaw with other assets. So when the dollar goes up, it can pressure asset prices here in the U.S. And then when the dollar goes down, the dollar index goes down in value, well, it can also pressure commodity prices and stock prices and things up. So think in terms of that. And of course, when the rate cuts come, that's going to pressure the dollar to the downside. And up until now, the dollar has been hanging out in this range that is somewhat stubborn, because it's still not sure when those rate cuts are coming. And this is why it's surprising to see that gold has been on the move, and even silver, despite the fact that the dollar has been fairly stubbornly hanging on to those levels. We're really looking for the U.S. dollar to break down below a key level of about 100 to 101. And we're still sitting on the U.S. dollar about 105, 104, 105, somewhere in that range. So that's been interesting to watch. And then, of course, as I had mentioned, gold, hitting that level of around 2450. Now, it's struggled to get back above that key level, that former area of resistance now, around 2450. But gold is trading today about 2350 or so. So it's about $100 off of its highs. And we would expect that as the dollar comes down, that you're going to see more upside for the dollar, but maybe not in the immediate term, because when you look at the technicals here on gold, we have rejected some of those higher prices. And so in the near term, we may kind of churn a little bit, which is not a big deal. And then for those of you who are following silver, we've seen also that push higher even this week, where we got silver back above $32. And silver is still nowhere near its high. Its high was reached, back in the last high was reached back in 2011 when it was around $50. Well, it's still trading at 32, so there's quite a bit of room. Gold's already hit a new high, but silver is still struggling to get to that new high. And we've seen a big influx of interest in the silver market since April. In April, we really began to see big volume coming in. And that's when silver was trading still at about $25, $26. And so we've really seen the volume come in and push this thing higher. And the volume, by the way, has continued. The bullish volume has continued into May. So silver still looking good on the charts. And by the way, silver had a really big, meaningful breakout in April. We had this multi-year breakout. We had a 15-year chart we've been talking about with our members for a long time. We were watching for that breakout right around the 25, 26 level. And we got it. We got a big breakout on silver last month on really big volume. So there's very likely more upside ahead for silver. And we're bullish on that market. And if you look, for example, at silver versus the S&P, just look at that ratio, you'll see that silver is trading at the lowest level versus the S&P, or recently was, since like in 20 years, right? So it's really been beaten down. So we're probably expecting to see some good upside there still left for the silver market. Now, the other thing I want to mention briefly is the fact that, remember, we talk about these interest rates. Well, as they go down, what also goes up? Remember that we're talking about the dollar here in terms of a seesaw. And then so when rates go down, the dollar goes down. And what goes up when rates go down? Well, when rates go down, bond prices go up, right? And so when the Fed begins to slash those interest rates, many of the various bonds along the yield curve, whether they're 30-year government bonds or even corporate bonds, shorter-term corporate bonds, you're going to see those begin to move higher. And to me, that's actually an opportunity. Now, I'm not a big bond investor, but for those who like bonds, I think this is my guess, is that you're going to see bonds really begin to rebound as the Fed begins to cut rates. That's just natural. And I think there's some really good opportunities in the bond space right now because we've seen such a beatdown. I mean, just take, for example, 30-year bonds here in the United States. They have declined. Just get this. 30-year bonds in the United States have declined 45% since April of 2020, right there during the middle of the COVID situation. I mean, that's the largest 4-year loss we have seen in the bond market in over a century, right? So we're talking about a massive decline in bond values. And I think it's exaggerated, quite frankly, because the yields have really not gone up that high. I mean, 5% interest rates, even though, nobody likes to have to pay that if you're a debtor. If you're a saver, you're enjoying those 5% interest rates. And you think about it, that would cause bonds to fall to their lowest level, or have the biggest decline, I should say, 45% decline over the last few years, because of 5% interest rates here in the United States. Well, it's obviously been other things, other factors as well at play, not just those interest rates. There's been other types of concerns. But we're of the opinion that bonds are well positioned now for a rally as those rates begin to come down. So as rates begin to come down, we see it as a tailwind, not just for bonds, but for stocks, and as well for some various commodities, including things like gold and silver. So there's a little thumbnail sketch of what we're seeing in the markets right now. And we do expect that we're going to end the year higher from where we are. We may have a little bit of a speed bump here in the summer. That's pretty typical. You'll see what we call the summer doldrums. And then activity really begins to pick back up at the end of the summer, say, September, October-ish. Sometimes that can be pretty volatile. But we're in an election year. And historically, election years are better than other years, all things being equal, for market performance. So if, all things being equal, we should expect to see the markets do pretty well and close out the year pretty well based upon this being an election year. And of course, all of us are probably ready for this election year to be over. It's been already mind-numbing to have to deal with this election for I don't know how long now. This has been the longest election cycle anyone can remember here in the United States. But let's switch gears here. Obviously, we see as rates come down, we see it as a tailwind for many assets. That means that, you out there who are listening to that, what's your takeaway for that? Well, we encourage you to be dollar cost averaging and through your investments. Keep investing in high quality assets. Continue to save for the future, and don't let the fear and the anxiety of today cause you to stop or to freeze up. Right? That's really the takeaway here, is that we see more upside ahead. And you may be looking at the stock market and you may be saying, "Wow, it's already up really big. How much higher could it go?" Well, people have been saying that now for I don't know how long. I mean, that's been a common refrain that people have had, and that's caused people to stay out of the stock market. And I think it's a negative thing. Now, you may not choose to invest in the stock market. You may choose to invest in commodities only, or you may choose to invest in real estate only. I think that it's better, quite frankly, to have a more diverse mix of assets that you can, have a diversified portfolio where you do have some stocks, you do have some real estate, you do have some commodities, and you're not overloaded in any one area. Because that can often, if you're not right, that can really hurt you over time. And time is the big kicker here. You've only got so much time. I've only got so much time. You've only got so much time. So we got to redeem that time and use it wisely when it comes to stewarding our finances. Now let's switch gears here for a minute because we are moving now towards talking about those AI ETFs. I want to talk about 3 AI ETFs today that we think are pretty well positioned to gain really well as AI goes higher, as we see more interest in AI, and as we see the stock, AI stocks do well. We'll talk about those 3 ETFs here in a little bit. But let's talk a little bit first about crypto. So we've been seeing Bitcoin now in the post-halving environment. This is the month after the halving. We had the halving last month, and typically halving months are negative. They're usually down. It's kind of like a sell the news event. But then, usually within a month or two after the halving in Bitcoin, you tend to see the price begin to rally. And that's what we seem to be seeing right now in the month of May. This is a positive month so far. But right now we've seen the price of Bitcoin still kind of consolidating below that recent high, that recent peak of about 73,750. And so it's been consolidating below that area. Not a surprise whatsoever. This is what you would expect from a high performing asset like Bitcoin. So Bitcoin still hovering in that consolidation zone. Not a lot of concern there on that front, as it trades just less than 10% or so below that former record high. And the bigger news came last week from Ethereum. That's the second largest cryptocurrency out there. And Ethereum has rallied nicely. It was trading below $3,000 earlier this month in May, as I record this. And it shot up to nearly $4,000 as it became apparent that the SEC seemed to be changing its mind about approving spot Ethereum ETFs. So Bloomberg has done a really good job of tracking this. They did a really good job of tracking the approval for the Bitcoin ETFs, and they had a really good track record of saying what the probability was for the ETFs to be approved. And they really nailed it. Well, they've also been following the spot ETF for Ethereum, and just a week or two ago, they radically changed their forecast. They were expecting less than a 50% chance of an approval of these spot Ethereum ETFs by the deadline, which the deadline for the SEC was May 23rd. They had applications from VanEck and from ARK Invest, and they were considering those. But then suddenly Bloomberg changed their tune and said, wait a minute, it looks like the SEC is very likely going to approve these. And that could open the floodgates, of course, for more institutional investments into Ethereum. And that's exactly what we saw. We've been seeing some really interesting things develop in the crypto space. The first thing was the fact that former President Trump began to talk about how he supported Bitcoin and how he was going to accept Bitcoin as a campaign contribution. Now, you may recall, this is quite a switch, because back whenever former President Trump was in the White House, he didn't have a lot of good things to say about Bitcoin. He was promoting the U.S. dollar and saying that Bitcoin was, just kind of on the fence about it, or he was quite frankly against it. But since, here we are in the final stretch, hopefully, of this election, and now suddenly Trump has started talking about how he likes Bitcoin and how he wants to accept Bitcoin, and how and so therefore we saw the Biden administration, who had been pretty opposed, similar to Trump, pretty opposed to the whole crypto market and had kind of a hostile approach to it. That all changed. And now we're beginning to see changes. And one of the biggest signs that we are seeing a shift in this, a pretty big sea change, was the Financial Innovation and Technology for the 21st Century Act. Talk about a mouthful there. We'll call it FIT 21. And Fit 21, that bill was passed by the House of Representatives last week. And that bill basically puts the Commodities Futures Trading Commission, the CFTC, in charge of regulating crypto. And it bypasses largely the SEC for that purpose. And so that is really big news because as you well know, we've been talking about on this broadcast how the SEC has been a major kind of serving as a blockade to crypto innovation and really not helping to clarify current regulations and just making it very difficult and cumbersome for the crypto community here in the United States. And so this passage now, what was so interesting about it was that the Biden administration said that if that bill passed, that they would not veto it. That was a big shift. So basically what's happening here is we're seeing a thaw at the federal level in terms of the cryptocurrency market. We're seeing the fact that the SEC now has approved a rule change so that these major exchanges can list spot Ethereum ETFs. And we're also seeing the Congress move to get the SEC out of the way and to replace them with the Commodities Future and Trading Commission in terms of being the major crypto regulator. I mean, this is all happening very quickly. And you can't help but think it has a lot to do with this election year. I mean, that's really how I'm viewing it. Well, either way, we'll take it. We'll take clearer, current and future regulations that could benefit the whole market. We will take, any kinds of regulations that can foster innovation and not stifle it here in the United States. So we could go on and on about Bitcoin and Ethereum and the crypto market, but we have more to cover. And so on the other side of this break, we're going to talk about those 3 top AI ETFs. We'll talk a bit about Nvidia and their latest earnings. All that on the other side of this break. Hold tight.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running personal finance podcasts on the web since 2010. We've been keeping you educated, equipped, and empowered on how to profit from the markets, but also just how to be a wise financial steward. We've talked about Bitcoin before people even really knew what it was on this broadcast. We talked about Ethereum before people really knew what it was. We've talked about many different topics that have really educated and equipped our listeners. And we're grateful to have you here. You can always learn more about us on our website, followthemoney.com. We have a huge trove of resources available to you, whether you are a premium member here or whether you're just someone just kind of kicking around the website. You'll find a lot of great information there, followthemoney.com. You'll also find us on social media. We're on Twitter at FTM Daily. We're also on YouTube. We have a big YouTube channel there as well, so be sure to check it all out. Now, let's turn to the topic of artificial intelligence. Artificial intelligence is really all the rage right now, and you can really see that from the latest Nvidia earnings blowout, where Nvidia shares surged above $1,000 to touch a fresh record high last week after they delivered yet another huge earnings beat. Now, I am long Nvidia. It is my largest stock holding. And so I say that in full disclosure so that you know that. It's in my long-term investment portfolio. And one of the questions I often get is, are you going to sell it? When are you going to sell it? I mean, surely it's not going to stay up here and keep going up. And, while Nvidia has been, one of the very best performing stocks in the stock market, I have to say, based upon my understanding of AI and based upon my understanding of the company, I am of the opinion, and this may be shocking, to some of you, but I'm of the opinion that we're still in the very early innings of Nvidia's rise and also of the rise in general of AI, that we really haven't seen anything yet. Remember that old song by BTU, "You Ain't Seen Nothing Yet"? I think that's exactly where we are here. I don't think any of us really understand what is about to happen, what we are getting ready to see in terms of new applications that are powered by these GPUs that Nvidia is putting out. And it's basically powering this AI revolution, this artificial intelligence revolution. So in this segment, I want to share with you 3 ETFs that I think give good exposure to AI for the future of AI. And before I do, I just want to break apart briefly this Nvidia report. So they put out their latest earnings release. The company delivered better than expected revenues, better than expected earnings for Q1. Their fiscal year ends in January, so this is actually Q1 2025 for Nvidia. But the company reported a 262% year-over-year revenue increase. I mean, that's just crazy, isn't it? And 461% year-over-year earnings increase. And they said that it was fueled by strong and accelerating demand for generative AI. What's generative AI? Well, that's things like OpenAI's ChatGPT. Many of us didn't realize how far along artificial intelligence was until we sat down with ChatGPT. And if you haven't tried OpenAI's ChatGPT, it's completely free. You should really go try it. I'm sure most of you have, but if you haven't, you really, really should. It is simply mind-blowing. However, I want to suggest to you that these are just the early innings, and that what we're seeing right now from things like ChatGPT, this generative AI where you input data and then you ask it to basically provide you with a solution. It's called inference. Basically, what we're seeing now, I think, is very early innings. And this is the same thing that Nvidia was saying. Nvidia is releasing they're basically powering this revolution, this AI revolution, through their computer chips, their AI chips. And they're so far ahead of their competition. It's simply astonishing. And the reason is because Nvidia saw this thing coming. I mean, this is what they've been talking about for some time. When I began investing in Nvidia, it was known as a gaming company. It was a gaming stock. And today, gaming, is a very small, relatively small portion of their overall revenues. Their overall revenues now are driven by data centers. And they have they have a tremendous, I think, growth path to see much more in the way of data center revenue, but also automotive. Nvidia has got its hands in a few different areas, including automotive, and many companies are dependent, including Tesla, upon using Nvidia. I guess Tesla for a while had been using Nvidia. They've been trying to move to their own thing, but companies like Microsoft and companies like Google, right? Companies like of this caliber, these are the customers of Nvidia, and these are hyperscalers, and so they're buying, massive amounts of these chips. And for every dollar that these hyperscalers are investing in Nvidia chips, they're able to get $5, $6, $7 back in terms of revenues. And so, how many of these things do you want? And that's the case where Nvidia can't keep these chips in stock. And they're going to be releasing new versions of these chips that are major upgrades. So it's going to create this upgrade cycle, which, just could really lead to some really big revenues over time and continued revenue growth for Nvidia, making it, I think, possibly the largest company, publicly traded company on earth to replace Microsoft, maybe in the next few years, especially if they keep this current growth trajectory. The company also, we had told our members early on, we had expected them to announce a stock split at this earnings call, and sure enough, they did. They didn't disappoint. They announced a 10-for-1 stock split effective on June 7th, 2024. And so while that's really not, that really shouldn't affect anything in terms, it's really just kind of a calculation that's done. It still tends to lead to more buying because you basically slash the price by a factor of 10. And then the number of shares you have is multiplied by 10. So it doesn't really change anything as far as for the investor, but it does make the stock more attractive. And we think that Nvidia could also, now with this split, once they get to the post-split era after June 7th, they would certainly be considered for inclusion in the Dow 30. And I think that would really be good news for Nvidia and for Nvidia shareholders. Now, let's talk about now what this all means in terms of investing. Sure, you could invest in Nvidia. As I mentioned, I'm invested in Nvidia, but some people say, I want to be invested in AI, but I don't necessarily want that single stock risk. So you could go out and invest in Nvidia, for example, or in Microsoft, or you could invest in a company like Tesla or a company, say, like Qualcomm. You just go to the list of different companies that have exposure, or Amazon. That's a big, AI play. And while, those are kinds of companies that you could invest in to make money from artificial intelligence going forward, some people just don't want to own a stock. They would rather own a basket of stocks. And that's what an ETF really does for you. So let's quickly define an ETF. If you're listening and saying, what the heck is an ETF? Well, it's an exchange traded fund. And they call them ETFs for short. But it's a type of investment fund that holds assets like stocks or bonds or commodities, but in this case, it's stocks. And they're like mutual funds, except they trade throughout the day instead of just once at the end of the trading day. So ETFs trade on a stock exchange just like stocks. And that means you can buy and sell ETF shares throughout the trading day at whatever the price it is. And ETFs are created by institutions that own the underlying assets, and then they kind of package them up, and then you are able to buy, when you buy a share of the ETF, well, you're buying a share of all the underlying, stocks that thing holds. So there's all different kinds of ETFs. We're not going to get into that today. There's index ETFs, bond ETFs, commodity ETFs, but we're going to be focusing upon these thematic ETFs, or these ETFs that are really focused upon a particular area of the market. And we're going to be focusing upon some ETFs that are going to give you exposure to these AI giants that I think would, certainly be attractive to those who are wanting to have exposure to artificial intelligence in their portfolios. Now, I should say in advance, I'm not a financial advisor, so I'm not giving you financial advice specifically, but I am just sharing with you some of my own research for you to do your own research on and do your due diligence and speak to a trusted financial advisor and find out what's right for you in your situation. Everybody's at different places in their financial life, and all depending upon your age as well and your risk tolerance. So let's go through these 3 AI ETFs that I think are very well positioned as we go forward in the future. So if I didn't own, Nvidia and Amazon and some of these other companies that are going to, I think, continue to see robust revenues from artificial intelligence and their efforts in that space, well, I would be looking for ETFs. And I actually own one of these ETFs. Actually, I don't own the ETF. I own a variation of the ETF. We'll talk about that in a minute. And let's actually begin with that one. We'll begin with the Invesco NASDAQ 100 ETF. That's QQQ is the ticker symbol. For years, I owned QQQ, but I made a change about a year ago, and I switched to QQQM. Not a change at all in the holdings of that ETF. It just had a slightly lower expense ratio, but it gave me all the same holdings. And I thought, well, if I get all the same holdings and I just pay a little less on the expense ratio, well, sign me up, So I made that move. But in general, when people talk about the NASDAQ 100, they're typically talking about the Invesco ETF. When we're talking about ETFs, the Invesco NASDAQ 100 ETF, the ticker symbol is QQQ, right? And so the NASDAQ 100 for a long time has been my personal niche, my personal trading niche, and also one of my favorite places to invest. And the reason is because over time, it has outperformed the S&P 500, which is, again, one of the most important indexes here in the United States. But when you drill down and you say, well, what does the NASDAQ 100 hold? Well, it holds, around 100 stocks that are non-financial companies, and many of them are tech heavy. They're kind of tech related stocks. So if we look at the top 5 holdings of QQQ today, we'll see that they are Microsoft. That's an AI stock, right? Apple is going to be releasing some AI news in June at its WWDC event, its Worldwide Developers Conference. And we're expecting some pretty big announcements there. So Apple, I think, even though Apple hasn't talked a lot about AI, I do believe that they're going to be talking about AI in the future. And I own Apple, by the way, in all full disclosure. Nvidia is the number 3 holding in QQQ. That's obviously an AI stock. Amazon.com is the 4th largest holding in QQQ. And that is, of course, a company that has a tremendous hand in AI. And then Broadcom, which is the 5th largest holding in QQQ. And that too has a role to play in AI. And if you look through the rest of the top 10, you're going to see companies like Meta Platforms, formerly Facebook, big AI play there. Alphabet, which is Google, formerly Google, that's obviously an AI play. Tesla is in the top 10. They're also, a big AI company in many ways. And so, especially if you've seen their latest full self-driving 12 release, which is just simply astonishing. And by the way, those things have been made possible by Nvidia, right? Nvidia's chips. We're currently on the Hopper platform when it comes to Nvidia and its big GPU platform. But by the end of the year, we're going to be moving to the next generation, which is called Blackwell. And that Blackwell platform, I think, is going to blow our minds when we see what that is capable of. And those things haven't even shipped yet. That's coming out later this year. So I think there's a big road ahead here for many of these companies, especially as they are buying up these NVIDIA chips. And as these NVIDIA chips get smarter and bigger and faster and more efficient, it's going to be really interesting to see. We live in a very fascinating time. Let's just put it that way. Okay, so QQQ, I think in my estimation, and admittedly, I own QQQM, and I own many of the companies that are actually held in those top 5. And so as I look at an ETF that's going to give me exposure to artificial intelligence companies, and that's going to make sure that the companies within the index itself remain relevant, I look at the NASDAQ 100. And for me, it's been a winner over the years. I like that market. I like that ETF. And I think that gives anybody good exposure to AI without taking that single stock risk. The problem is if you buy just a single stock, then you're kind of beholden to whatever happens. I mean, the CEO could do something crazy, or or they could have a big miss, or they could really misfire on some sort of program. I mean, all different kinds of things can happen to a single stock, and so there's risk there. Whereas when you own a big basket of stocks, like with an ETF, it's just less that could possibly go wrong, because if one stock gets hammered, well, the whole index necessarily won't. Okay, so QQQ would be the first ETF that I would be looking at. The second ETF that I would be looking at, one of my favorites, I don't own this one, but it's one of my favorites, and we track it in our ETF leaderboard here for all of our Follow the Money members. And that is the Vanguard Information Technology ETF, and it is the ticker is VGT. And by the way, if you are using mutual funds, there's actually a mutual fund that tracks this over in the at Vanguard. It's called the Vanguard Information Technology Index Fund Admiral Shares. So those of you with 401ks and you have only mutual funds you can invest in, you can look that one up. The ticker on that one is VITAX. What I like about VGT now, this is the ETF, the Vanguard Information Technology ETF. What I like about this is it has had a very good return profile over the years. It's really proven itself. Vanguard just has a great name, and they've really done a great job in the asset management space. But also speaking of, overall performance, it doesn't come with a massive expense ratio. The expense ratio is 0.1%. And that's what Vanguard is known for, is that really low expense ratio, which it really matters. Over time, those expense ratios can really eat into your profits. So you've got to be real careful there. But VGT is just really a powerful ETF that has provided very consistent returns over the years. And if you look at the current number of holdings right now in VGT, it's around 313. It actually tracks the MSCI Info Technology Index, which is its benchmark. But it's got about a little more than 300 stocks, so it's a bit more diversified than the NASDAQ 100. But when you look at the breakdown of the top holdings, well, you're going to see very similar names here. It's Microsoft is the first holding. That's an AI company. Apple, we already said that's also an AI company, Apple. And then you have Nvidia, number 3, looking very similar here to the NASDAQ 100. And then you also have Broadcom and Salesforce.com rounding out the top 5. And then if you look through the rest of the holdings in the top 10, you'll see things like AMD. That's certainly moving in that's one of the biggest competitors, by the way, for Nvidia. So that's certainly compete in the running to be an AI stock. Adobe, that's also, they have their own AI tools they've come out with. So there's lots of AI plays here within the Vanguard Information Technology ETF. And the reason why I'm bringing these ETFs up is because of their return profile. Not only are they special, not only do they give you exposure to these companies that are, dominating the AI space, but they also have a track record that show that they know what they are doing. And they also, most of them have relatively low expense ratios, which is really important. And also, if you look at some of the more specific AI ETFs that are out there, like they say, hey, we're an AI ETF. Well, look at their performance. And that's one of the things you want to see is how are they performing versus, say, the NASDAQ 100, or how are they performing versus VGT, for example. That's really important for you to consider. Because again, anybody can slap AI on their ETF, but are they actually, earning, are they actually beating some of these really big ETFs that aren't using that, but are already investing in these spaces and are actually not charging massive expense ratios like many of these quote unquote AI ETFs are? Okay, so we have 2 ETFs we've talked about. The NASDAQ 100, which you can invest in through the Invesco NASDAQ 100 ETF, ticker symbol QQQ. You also have the Vanguard Information Technology ETF, ticker symbol VGT, which also comes with a mutual fund, which is VITAX if you need to invest in mutual funds instead. And that also has a relatively low expense ratio. And then now the third and final ETF that I want to talk about, it's actually done the best this year out of all 3 of these, is the iShares Expanded Tech Sector ETF. Now, this one has almost doubled the performance of the other 2 this year. And what the iShares Expanded Tech Sector ETF delivers is broad exposure to the tech sector and tech-related companies, hardware, software, and all of it in between. It really focuses upon North American technology-related companies as opposed to global. The ticker symbol for the iShares Expanded Tech Sector ETF is IGM. It carries an expense ratio of about 0.41. Now, it carries the largest expense ratio out of all 3 of these. The NASDAQ 100, by the way, its expense ratio is around 0.2%. So again, you have the Vanguard, which has 0.1%. That's the lowest. QQQ has a 0.2%. That's still very low. And then you have this IGM ETF, which carries a 0.41% expense ratio. Practically double the NASDAQ 100. But it's also had better returns than the NASDAQ 100 over the last year and also over the last year to date, total returns year to date. Now, when you look and drill down into IGM, you say, well, how many companies does this ETF hold? It holds a basket of about 278 holdings. And so it's slightly less than the VGT ETF, but it's a lot more than the NASDAQ 100 ETF. So you have a little less concentration here compared to the NASDAQ 100. And then when we look at the holdings here, perhaps this explains why IGM has actually outperformed these other two ETFs this year, is that their number one holding is Nvidia, followed by Apple, followed by Microsoft, and then Meta platforms, formerly Facebook, and then Alphabet, formerly Google, right? So these companies here are obviously the juggernauts of the AI space. And when you go down the list, you'll see others like AMD in the top 10, Broadcom, Salesforce. And so this particular ETF has actually outperformed the other two. And I do like its composition, quite frankly, a lot. I mean, when I look at the holdings here and I see how they're weighted, this one looks really good. And so it's not really a surprise that it's actually done better this year than the other two ETFs. If you break it down by sector, nearly 26% of the fund is focused upon semiconductors. And again, that's really the picks and axes and shovels that are really kind of enabling the AI rush, if you will. And that's important to keep in mind, is that as we look at companies like Nvidia that are selling these chips, the semiconductor companies, the AMDs that are really powering this AI rally, you say, well, they're going to make all the money. Well, that's silly. I mean, that's like thinking about the gold rush in California, for those familiar with the history books here in the United States, when we began to go out west and dig for gold. You say, well, the only people making money are the people selling the picks and the shovels. That's not true. The people selling the picks and the shovels are definitely making money. That's what Nvidia is. They're selling the chips that make it possible for these companies to go out and do these really cool applications with AI. They are powering that. But you got to remember that back in the gold rush, it wasn't the guy who was selling picks and shovels who was digging up the gold, right? So the person who finds the gold actually can make a lot of money. And that's what's happening now, is that these companies that are buying Nvidia chips, the current Hopper platform, they're able to turn every dollar spent on those into around $5. So who's making more money? Well, Nvidia is making money from selling the chips, but the smart companies who buy the chips are actually able to make $5 for every dollar they invest in these chips. So you can see that there's going to be a lot more money made as these companies really leverage the power of these AI chips that are being put out by companies like Nvidia. So there you have 3 AI ETFs. If you've been looking at the space, you've been considering investing further in artificial intelligence, these are some ETFs that I like, that I've done research on, and that I like to track, but they may not be right for you. Of course, you always want to sit down with your own financial advisor, see what's right for you, do your own due diligence. But I think these 3 give nice broad exposure to some of the very best companies in the artificial intelligence space. And quite frankly, friends, I see a lot of upside still left. And I think we're in the very early innings of this artificial intelligence boom. I think there's a lot more upside. I don't think it's going to go straight up. And I think any kind of big pullbacks or sell-offs in these types of companies, or even in these ETFs, will represent a longer-term opportunity for those who are patient and can sit through some of that volatility. All right, friends. Well, that brings us to the end of today's broadcast. I sure hope you found this episode helpful. And as we wrap up today's exploration of the top 3 AI ETFs, it's clear that the realm of artificial intelligence offers some of the most compelling investment opportunities of our time. Each ETF we profiled today provides a unique approach to capturing the growth potential of AI, from broad exposure to specific industry applications. And as investors, it's our responsibility to choose wisely, to balance potential rewards with the risks that are inherent in investing in innovative technologies. And this is part of what makes investing in AI so exciting and exhilarating, is that it's not just about financial returns. It's about participating in the development of technologies that are going to redefine every aspect of our lives. And so with all that said, I want to leave you with our final word. This time it's a potent reminder from Elon Musk when he said, "Artificial intelligence will be the best or worst thing ever for humanity. So let's make sure it's the best." This quote really shows the dual nature of AI's promise and its peril. So as investors and as citizens, we have a role to play in steering this powerful technology towards outcomes that enhance our well-being and propel humanity forward. And that's just something to think about. Thanks for tuning in to today's episode. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial